Let's talk about a company that did get beaten up pretty bad. I think you're going to talk more about that, but we're talking about UnitedHealth. Their symbol is UNH. They're in the healthcare plans industry. Not much float here on the short side, 1.2, 91% institutional owned. So institutions love the stock, but individual investors don't seem to. PE ratio looks okay now, 17.5 versus 18.2. Price of sales 1. Double the industry at 0.5. Remember, you want these valuation ratios lower, not higher. Price to book value 3.8 versus 2.4. Price to cash flow 13.6 versus 13.1. And the PEG ratio looking very good. It's a 1 versus 4.9. And that one you do want lower than the industry. Their earnings were down 5.3% over the past year, but the industry was down 8%. So even though they're down, they did better than the industry did. Sales, they were up 5.5%, not quite as good as the industry, up 7.1%. Wow, the 5-year growth rate, I'm wondering if this is going to decline after you talk about what you have there, but the 5-year earnings per share growth estimate going forward from the analysts is 15.2. That's about 3 times the industry of 5.5. That holds. That's a pretty good indicator to maybe look at this company. They do pay a 2% dividend, use 52% of the earnings to pay that out. Taking a look at the balance sheet, current ratio 0.8, but that's normal for the industry at 0.6. Debt to equity 0.8, that is the same as the industry. One thing surprising to me, they have a lot of intangible assets, 44% intangible assets. That's pretty high for
likely acquisitions, I would presume.
Yeah, I guess so. But I'm kind of surprised by that. Net profit margin 3.6, above the industry at 2.2. Return on equity is 15.6. We like that number above 15, which it is, and return on invested capital of 10.8. We like that above 10. So there's some good things here. What do you got?
Yeah, and I was going to say, too, on the intangible side, the one thing that's interesting about UnitedHealth Group is you compare it against I'm going to look at Cigna, for example. Cigna is pretty prevalent in just kind of health insurance and the PBM side. I mean, UnitedHealth, they're kind of in more Medicare. They're in the health group plans. They're in the PBM side. Then they're also in like kind of doctors networks. I mean, they are, I'm going to say, more of a diversified health group than some of the other insurers, which maybe is one of the reasons they've carried a higher premium. But I mean, this pullback is, kind of intriguing here. I mean, the current price for UnitedHealth Group is $418.64. 52-week range, they hit a low on Friday at $412.02 and the high $630.73. Wow. Year to date, the stock's down about 17%. And actually, last week after they reported earnings, the stock fell about 22%. Those earnings were quite concerning, I'd say. The adjusted earnings of $7.20 on revenue of $109.58 was short of the $7.29 in earnings per share and $111.6 billion that analysts were looking for. They also did slash their full-year guidance. So, I mean, there were some big concerns in that report. Obviously, you're going to have big concerns to have a 22% pullback, but that has caused UnitedHealth to trade at levels not seen since October 2021. But going forward for the stock, I mean, is there opportunity here? I'm going to say maybe. And the reason I say that is December 2026 estimated earnings per share, $30.95, gives you a target sell price of $513.77. That's an estimated return about 23%. So we just need a little bit more of a pullback to hit that 30% margin of safety that we look for to buy companies.
And Jason, look at the analysts going back 90 days. They have reduced their earnings by about 7.2%. So maybe be a little more patient to see if more comes down. But I think there could be something here. But I believe a lot of the problem was with the Medicare side, correct?
I mean, Medicare has been a challenging business, I know. And also, too, a lot of that's stemming from the medical care ratio. So they're paying out more for medical care than they're collecting in premiums. That's what the medical care ratio looks at. And from what I've read and just kind of loosely here is that a lot of these seniors that delayed, kind of elective surgeries for years are now going back to get those elective surgeries done. So it's kind of generating this pipeline. And UnitedHealth is having to pay out for that, which is costing them more money and costing that medical care ratio and spiking that level, which generally investors don't like to see. But to me, that's a short-term concern and could create some potential interest in buying a stock like UnitedHealth if it does fall further.
And it's very hard in the industry because we don't know what changes are going to come up with Medicare, Medicaid as well, I think, for the states. I